1. Reevaluate the standard deduction. Taxpayers can choose to itemize certain deductions or take the standard deduction based on their filing status. Itemizing deductions saves tax if the total exceeds the standard deduction. The number of taxpayers who itemize dropped dramatically after the Tax Cuts and Jobs Act, TCJA, nearly doubled the standard deduction. The OBBBA increases it further. The standard deduction for 2025 is $15,750 for single filers, and married individuals filing separately, $23,725 for heads of households, and $31,500 for married couples filing jointly. Taxpayers age 65 or older or blind are eligible for an additional standard deduction of $2,000 or, for joint filers, $1,600 per spouse, age 65 or older or blind. For taxpayers both 65 or older and blind, the additional deduction is doubled. But other OBBBA changes could make itemizing more beneficial. For example, if you've been claiming the standard deduction recently, the expanded state and local tax, SALT, deduction might cause your total itemized deductions to exceed your standard deduction for 2025. See number 2 below. If it does, you might benefit from accelerating other itemized deductions into 2025. In addition to SALT, potential itemized deductions include qualified medical and dental expenses to the extent that they exceed 7.5% of your adjusted gross income, home mortgage interest, generally on up to $750,000 of home mortgage debt on a principal residence and a second residence, casualty losses from a federally declared disaster, and charitable contributions. See number 3 below. Note, too, that higher earners will face a limit on their itemized deductions in 2026. The OBBA effectively caps the value of itemized deductions for taxpayers in the highest tax bracket, 37%, at 35 cents per dollar, compared with 37 cents per dollar this year. If you're among that group, you may want to accelerate itemized deductions into 2025 to leverage the full value. 2. Maximize your SALT deduction. The OBBBA temporarily quadruples the so-called SALT cap. For 2025 through 2029, taxpayers who itemize can deduct up to $40,000, $20,000 for separate filers, with 1% increases each subsequent year, meaning $40,400 in 2026, and so on. Deductible SALT expenses include property taxes for homes, vehicles, and boats, and either income tax or sales tax, but not both. The SALT cap is scheduled to return to the TCJA's $10,000 cap, $5,000 for separate filers, beginning in 2030. In the meantime, the temporary limit increase could substantially boost your tax savings, depending on your SALT expenses and your modified adjusted gross income, MAGI. The allowable deduction drops by 30% of the amount by which your MAGI exceeds a threshold of $500,000, $250,000 for separate filers. When MAGI reaches $600,000, $300,000 for separate filers, the $10,000 or $5,000 cap applies. If your 2025 SALT deductions exceed the old $10,000 cap, but your total itemized deductions would still be under the standard deduction, bunching could help you make the most of the higher SALT cap. For example, if you receive your 2026 property tax bill before year-end, you can pay it this year and deduct both your 2025 and 2026 property taxes in 2025. You might increase the deduction further by accelerating estimated state or local income tax payments into this year, if applicable. You could bunch other itemized deductions into 2025 as well. See number 1 above. In 2026, you'd go back to claiming the standard deduction. and then you'd repeat the bunching for the 2027 tax year and itemize that year. 3. Prepare for changes to charitable giving rules. Donating to charity is a valuable and flexible year-end tax planning tool. You can give as much or as little as you like. As long as the recipient is a qualified charity, you can properly substantiate the donation and you itemize, you'll likely be able to claim a tax deduction. But beginning in 2026, the OBBBA imposes a 0.5% of adjusted gross income (AGI) floor on charitable contribution deductions. The floor generally means that only charitable donations in excess of 0.5% of your AGI can be claimed as an itemized deduction. In other words, if your AGI for a tax year is $100,000, you can't deduct the first $500, $100,000 x 0.5% of donations made that year. So if you can afford it, you might want to bunch donations you'd normally make in 2026 into 2025 instead, so that you can avoid the new floor. Bear in mind that a charitable deduction might nonetheless be more valuable next year if you'll be in a higher tax bracket. One way to save even more taxes with your charitable donations is to give appreciated stock instead of cash. You can avoid the long-term capital gains tax you'd owe if you sold the stock and also claim a charitable deduction for the fair market value, FMV, of the shares. On the other hand, if you don't itemize, you may want to delay your 2025 charitable contributions until next year. Beginning in 2026, the OBBA creates a permanent deduction for non-itemizers' cash contributions, up to $1,000 for individuals and $2,000 for married couples filing jointly. Donations must be made to public charities, not foundations or donor-advised funds. Manage Your Magi is the trigger for certain additional taxes and the phase-outs of many tax breaks, including some of the newest deductions. For example, the OBBA establishes a temporary senior deduction of $6,000 for taxpayers age 65 or older. This can be claimed in addition to either the standard deduction or itemized deductions. But the senior deduction begins to phase out when MAGI exceeds $75,000, $150,000 for joint filers. As discussed in number 2, the enhanced SALT deduction is also subject to MAGI phase-outs. So too are the child tax credit and the new temporary deductions for qualified tips, overtime pay, and car loan interest. In terms of being a tax trigger, your MAGI plays a role in determining your liability for the 3.8% net investment income tax. It can pay, therefore, to take steps to reduce your MAGI. For example, you might spread a Roth conversion over multiple years, rather than completing it in a single year. You can also max out your contributions to traditional retirement accounts and health savings accounts. If you're age 70.5 or older, qualified charitable distributions, QCDs, from your traditional IRA are another avenue for reducing your MAGI. While a charitable deduction can't be claimed for QCDs, the amounts aren't included in your MAGI and can be used to satisfy an IRA owner's required minimum distribution, RMD, if applicable. This can be beneficial because charitable donation deductions and other itemized deductions don't reduce MAGI, and RMDs typically are included in MAGI. Begin planning now. Don't miss out on both new and traditional planning opportunities to reduce your 2025 taxes. The best strategies for you depend on your specific situation. We'd be pleased to help you with your year-end tax planning.